Welcome to the deep dive. Today we're tearing into something really interesting, a corporate action that's, well, purely mathematical on paper.
hmm
Entirely cosmetic, you could say. And yet, somehow, it still injects this uh, huge wave of excitement into the financial markets. We're talking about stock splits.
Right. It's one of those things that makes you scratch your head sometime.
Exactly. So our mission today is to get under the hood, understand this paradox. If a stock split changes absolutely nothing fundamental, not the company's value, not your slice of the ownership pie, why does the announcement grab headlines?
And crucially, why does it often lead to this noticeable short-term bump in the stock price?
Yeah, what's going on
It
there?
really is a fascinating quirk of market behavior. So maybe we should start with the basics, just define what a split actually is.
Good idea.
Okay, so a stock split happens when a company decides to increase the total number of its shares out there, the outstanding shares.
And because they increase the number of shares.
The price per share goes down proportionally. The key thing, though, the absolute key, is that the company's total value, its market capitalization, stays exactly the same.
Okay.
The classic analogy is think about a cake or a pizza. Let's say you have one big pizza worth $500.
Mm,
You cut it into two slices. Now you have two slices, right? But each one's worth $250.
more pieces, same amount of pizza.
Exactly, same total value. That's a stock split in a nutshell.
All right, so let's get into the nuts and bolts then, the math. How does a standard, the forward split work? You usually see ratios like 2 for 1, 3 for 1.
Yeah, sometimes even higher, like 10 for 1.
So let's take a simple one. Say you own one share of a company and it's trading at $100. They announce a 2 for 1 split. What happens?
Okay, so on the split date, your single $100 share just poof, it becomes two shares.
And each of those is worth.
$50.
Right.
Two shares at $50 each. Your total holding value is still $100. Your percentage ownership in the company hasn't changed one bit.
Right.
And for you, the investor, it's usually pretty seamless. Your broker just handles it. One day you have X shares at price Y, the next day you have more shares at a lower price.
The additional shares just appear in your account.
They just appear. The value balances out perfectly. But, and this is a big but for anyone looking back,
Uh-oh. What's the catch?
historical data. You need to be really careful with old stock charts.
Why's that?
Because most platforms, most charting tools, they automatically adjust the historical prices backwards to account for splits.
Ah, okay. So what does that mean practically?
It means if you're looking at a chart for a stock that, say, recently split 10 for 1 when it was trading at $1,000,
Mm-hmm.
the chart might make it look like it was always trading around $100, even years ago.
So if you didn't know it was split adjusted, you'd think the long-term growth was much lower than it actually was.
Exactly. You could completely misinterpret the historical performance. It's a really important tip. Always check if your data is split adjusted.
That's a great point. And it brings us right to a huge recent example, doesn't it? NVIDIA.
Oh, yeah. Perfect example.
Their stock price just soared, hit something like $1,200 a share. And then boom, June 2024, they did a 10 for 1 split.
Dropped it right down to around $120 per share overnight. Same massive company, same market cap, but suddenly that price tag looks very different.
It feels more accessible, even if technically it wasn't any less accessible before with fractional shares.
Right. The psychology is powerful.
And think about the long-term effect. NVIDIA's done, what, 6 splits since they went public?
6 forward splits, yes.
So if you were lucky enough or smart enough
Yeah.
to buy one single share way back before their first split in 1999,
Mm-hmm.
after this latest 10 for 1 split, how many shares would that one original share have become?
You have to multiply all the split ratios together. Let's see, 2 times 1.5 times 2 times 4 times 10. That's 480 shares.
Oh, one share becomes 480. Again, the value increase came from the company's growth, not the splits themselves, but the number of pieces is just
Right.
huge.
It really illustrates the kind of growth that often precedes a split. And that growth is tied into the reasons companies actually do this. It costs money, takes effort. Why bother?
Okay, yeah, let's get into the why. What are the rational reasons management gives?
Well, there are a few main stated reasons. First one is usually liquidity.
Meaning?
More shares outstanding generally means more trading activity. It can potentially narrow the gap between the buying and selling price, the bid-ask spread, makes it easier to trade in and out.
Okay, smoother trading. Makes sense.
Second, and this is a big one we've touched on, is perceived affordability.
The psychology again, making it look cheaper for retail investors.
Exactly. It sounds almost silly in the age of fractional shares, but companies know investors have these psychological price barriers.
It's fascinating. You mentioned sources showing this consistency, like the average NYSE stock price historically.
Yeah, it's pretty remarkable. For decades, from like the 1930s right through to the 2000s, the average nominal share price hovered around $30 to $40.
And companies still aim for that kind of range post-split, like $30, $50.
Often, yes. It seems to be a comfort zone. They're trying to avoid certain resistance points.
Like what?
Well, retail investors might look at a $1,000 stock and just feel like it's too expensive, even if they could buy $50 worth.
Right, the sticker shock.
And on the flip side, if a stock price falls below, say, $5, it starts getting tagged as a penny stock.
Which institutions don't like.
Exactly. Many institutional investors have rules against holding stocks below a certain price point. So management wants to stay out of that territory, too. They're trying to thread that needle.
It's just wild that we're still kind of stuck on that $40 ideal price from, 80 years ago. But okay, there's a third reason too, right? Signaling.
Yes, signaling. This is important. A forward stock split is generally seen as a bullish signal.
How so?
Management is effectively saying, hey, we've had great growth, our share price is high, and we're confident it's going to keep going up.
Ah, we expect future growth, so we're making the price more manageable now before it gets even higher.
Precisely. It's a vote of confidence from the inside.
Okay, so liquidity, perceived affordability, signaling, those make sense. But you also mentioned something important.
The contrast with modern markets.
Yeah, fractional shares exist now. Anyone can buy $50 of NVIDIA, whether it's $120 or $1,200 a share. So does that affordability reason still hold up?
That's the debate. Practically speaking, the need for splits to enable small investments has really diminished. Sophisticated traders, algorithms, they don't care about the nominal price.
And is that why we're seeing fewer splits overall?
Almost certainly. The frequency of stock splits peaked in the late 1990s during the dot-com boom and has trended down significantly since then. Technology has reduced the mechanical need.
Okay, so that perfectly sets up the big mystery then.
Yeah.
If the practical need is fading, why does the market still react so strongly? Why do we still see these price jumps?
This is where we leave pure mechanics and enter the fascinating world of behavioral finance.
The announcement premium. You mentioned research shows this consistent bump.
Yes, consistently. Studies find that on average, just the announcement of a stock split leads to abnormal returns, meaning the stock price jumps more than the overall market by about 2% to 4%.
2 to 4% just for announcing you're cutting the pizza into smaller slices.
Pretty much. Think about a huge company, say $1 trillion market cap. A 4% bump is $40 billion in value created, seemingly out of thin air just from that news.
That really flies in the face of the efficient market hypothesis, doesn't it? The idea that prices reflect all known information.
It absolutely challenges it, because the split itself adds no new fundamental information about the company's value or prospects. So why the jump? Behavioral finance gives us the clues.
And the core concept is?
The nominal price illusion. It's a cognitive bias. Our brains aren't purely rational calculators. We see that lower post-split price, and even though we know the value hasn't changed, it feels cheaper or like it has more upside potential.
Okay, let's break down the specific biases. You mentioned NVIDIA going from $1,200 to $120. The obvious one there feels like anchoring bias. We were anchored to that high $1,200 number. Seeing $120 just feels like a bargain, even if it isn't mathematically.
Your brain latches onto the previous high price as a reference point, making the new, lower price seem incredibly attractive. It creates this perception of getting a discount.
Right, and that perception probably fuels the next bias. Availability bias.
Exactly. A stock split is news. It gets talked about everywhere. Financial TV, websites, social media. Analysts update their reports.
It becomes highly visible.
Highly visible. All that buzz, all that attention suddenly makes the stock salient in investors' minds. It increases demand simply because people are suddenly thinking about it and seeing it everywhere.
Okay, anchoring makes it seem cheap. Availability puts it front and center. What else?
There's also something researchers call gambling preferences, or sometimes lottery preferences.
How does that work?
It's the idea that owning more shares, even at a lower price, feels psychologically better, maybe more powerful, or like it has more potential for a big percentage gain. People might prefer owning, say, 100 shares at $20 rather than one share at $2,000.
Even though the total investment is the same.
Even though it's the same $2,000, having 100 units feels like you have more chances for one of them to pop, like holding more lottery tickets. It taps into that desire for potential explosive growth, even if it's irrational.
It's almost embarrassing to think that part of a multi-billion-dollar market reaction might just be people not quite grasping the math.
Well, some researchers offer that as a more prosaic explanation, too. Perhaps some investors genuinely struggle to adjust their valuation models or thinking correctly after the nominal price changes.
The collective irrationality, or maybe just inertia, is powerful enough to create a real effect. And you mentioned it even lasts, this post-split drift.
Yeah, that's another observed phenomena. Often that slight upward pressure on the stock price doesn't just happen on announcement day. It tends to persist or droop upward slightly, even in the days and weeks after the split actually happens. The psychological impact lingers.
Fascinating. And just quickly, before we flip to the opposite, you mentioned practicalities like options and taxes earlier. Are those affected?
Good question to circle back on. Generally, no major headaches. For options contracts or if you're shorting the stock, the terms get adjusted.
How so?
The number of shares per contract and the strike price are changed proportionally, so the overall value of your position remains the same. Your broker handles this automatically.
And taxes. Does a split trigger a tax bill?
Nope. No taxable event occurs just because of the split. You don't realize any capital gain or loss. Your cost basis per share simply adjusts downwards. So if you bought one share at $100 after a 2-for-1 split, your basis becomes $50 per share for each of the 2 shares.
Okay, good to know. No major logistical nightmares there. So we've covered the forward split, the growth signal. Now let's look at the flip side, the reverse stock split.
Right, the opposite action. Instead of creating more shares at a lower price, a reverse split combines multiple existing shares into fewer shares, each with a proportionally higher price.
Okay, so if a stock is $1 and they do a 1-for-10 reverse split.
Your 10 shares at $1 each become 1 share at $10. Again, total value $10 stays the same.
Why would a company do this? It feels counterintuitive if the goal is usually accessibility.
It's almost always done out of necessity, not optimism. The primary driver is usually to avoid being delisted from a major stock exchange.
Because exchanges have minimum price requirements.
Exactly. The NYSE, the NASDAQ, they often require stocks to stay above $1 per share, sometimes higher, like $4 or $5, depending on the specific rules and circumstances. If a company's stock falls below that, maybe due to financial trouble, a reverse split is a way to artificially boost the price back into compliance.
So it's more about survival than signaling growth.
Very much so. You mentioned Citigroup earlier. They did a big one back in 2011.
Right, what was their situation?
Their stock price had languished after the financial crisis, down around $4.50. They did a 1-for-10 reverse split, took the price up over $45 overnight. Part of their stated role was to reduce volatility and make it less attractive to penny stock speculators.
But the signal it sends is very different from a forward split, isn't it?
Completely different. While a forward split is seen as bullish, a reverse split often carries a negative stigma. It can signal that the company is struggling, that management lacks confidence in organic price recovery, or that they're just trying to stay listed. The market perception is generally unfavorable.
So fascinating. Two sides of the same mathematical coin, changing nothing fundamental, yet triggering completely opposite emotional and market reactions.
It really highlights how much psychology drives market behavior, doesn't it?
Absolutely. So let's bring it back to the listener. If you're an investor and a company you follow announces a split forward or reverse, what are the key things to keep in mind?
Well, first, understand the mechanics. The split itself doesn't change your wealth. Second, watch the key dates.
Which are?
There's the announcement date. That's when you typically see that initial market reaction, the premium pop. Then there's the record date. That's the cutoff day the company uses to see who's officially on the shareholder list to receive the new shares. And finally, the distribution date, sometimes called the effective date or pay date. That's when the new shares are actually issued, the split happens, and the stock starts trading at its new adjusted price.
Got it. Announcement, record, distribution. But the core takeaway seems pretty clear. Stock splits, forward or reverse, are ultimately cosmetic adjustments. They don't alter the company's underlying business, its earnings potential, or your percentage stake in it.
Precisely. A forward split is often a symptom of past success. The price got high because the company did well. It's not the cause of future success.
Right. So when you're evaluating a company,
ignore the nominal share price. Focus on the fundamentals. What are the earnings? What's the debt load? How's the management? What's the competitive landscape? Dig into the actual business value, not the price tag per share.
don't fall for that nominal price illusion we talked about. 10 shares at $10 is not inherently better or worse than one share at $100 if the underlying company's the same.
Couldn't say it better myself.
Okay, so we've covered the mechanics, the psychology, the reasons why, the reverse splits.
Yeah.
But let's end with that provocative thought.
Okay.
The trend for splits might be decreasing. Technology like fractional shares makes them less necessary. But the market still rewards companies, often with billions in added market cap, just for announcing one.
The announcement premium persists.
So, if market participants, even today, are collectively willing to pay more for a stock simply because its nominal price looks lower, even when they know nothing fundamental changed, what does that truly tell you about how rational the market actually is, even in the 21st century?
Yeah, makes you think, doesn't it? How much is driven by cold calculation versus human psychology?
Something to definitely mull over.